Hi, John. Thank you so much for coming to the Investor Talk. How are you today?
Thanks very much. I'm doing great. Thank you.
Thanks for coming. Thank you very much for your time. So let's start giving a bit of background on yourself.
Okay, so I run the Startup Investor Accelerator, which is a program from Mossy Ventures, which is my overall program, which is a angel accelerator. We call it the last thing we just finished last week was the Transatlantic Angel Conference, which is an effort to grow new angel investors and make them stronger and more effective as angel investors. And as a part of that program, we gather a bunch of startups that go through as part of the process. And we invest in one of the companies that comes through. And as a result, everybody gets stronger and better.
Thank you. Thank you very much. So can we start talking more in details how the program works for both sides, startups and angels?
Yeah, so the analogy I've been using is this notion of we're sort of the chemistry lab class for the chemistry thing. You know, you go to the chemistry class and they teach you about all the elements, and then you go to the chemistry lab class and you blow things up. And so we're the blow things up thing, learn by doing. We teach angel investing by doing angel investing. So when a startup gets going, they typically think, oh, if I just had some money, I could do very well. And so they go off and chase the money, when in fact, money is most of the time not the problem that's in their way. And so the typical problem for startups is that they don't have the right team, or they don't have the right skills, or they don't have the right perspective on the problem they're trying to solve, and they're struggling a little bit. And so they think that if I could just get some money and hire a person to finish the product, then everything would be good. On the other hand, most of the people who are wealthy enough to write angel checks, where they're writing business angel investment checks, they don't do it. So in the United States, where we've been running a Seattle Angel Conference for 10 years now. We're in Seattle Angel Conference 22 at the moment. In the US, 10% of the population is accredited by law, which allows them to write an angel investment check. And of that 10%, only 1% actually write checks. And so we're trying to make that bigger so that it's 2% or 3% that do that. And part of it is that people just don't know that they could write checks, and they don't know what they need to do. So we gather 20 to 40 angels, most of whom have never written an angel check before. And we gather 40 or 50 companies. And then we ask the companies to present to the angels, and then we cut them in half, and we do that 3 times. And then in the end, we have some finalists, and we form due diligence teams and explore in detail what the company said versus what the company actually is doing. And we try to decide, is this company investable? And then of these, which one is the right one for us to invest our money? We gather $5,000 per investor. So we're creating a fund between $100,000 and $200,000, which is a useful size check for most companies that are very close to their first revenue. And so early companies come in, and early angels come in. And by asking the hard questions that a company needs to have the answers to, often then the company realizes they should have a better, more justified answer to the question. So the companies get stronger. So the 2 barriers in most startup ecosystems are the skills of the company are not up to the task yet, and the capital is missing in the local ecosystem. And so by doing this program, we get both to happen. We get more capital in the local ecosystem, and we get stronger companies that have much more precise, much more confirmed data about where they're going with their company. And because we've done that for a decade in the United States, we have 500 investors that are new investors. Of those 500, 200 are relatively active in our ecosystem. We have 4 groups that have spun out because our alumni got so excited that they formed another group. And so of those 200, a few of those are now coming close to their 100th investment. And if we count all of the alumni organizations, our 5 million that has been deployed over the 10 years in Seattle has turned into over $80 million in the ecosystem of our investors doing things. And that's the ones I can count, not the ones that are not telling me what they're doing. So it's an amplifier for the ecosystem to make the company stronger and to get more smarter capital into the ecosystem. And now we've helped San Diego, Kelowna, Alaska do it. We've run a health version last year, and now we're experimenting with how can we do this in Europe. And so we have the Transatlantic Angel Conference, which just finished. We had companies from all over Europe and greater Europe. The finalists were from Israel, Romania, UK, and US. And then the investors were from Israel, Portugal, Spain, Germany, Estonia, UK, Canada, and the US. And everybody learned a lot in the process. And in the end, we have an investment in a Romanian company.
May I ask you, in terms of programs, in terms of startup that can apply, do you have any specific requirements for startups when they can anyone apply?
Yeah, any company can apply. Typically, we're putting geographic boundaries on it because we want to understand the legal nature of the investment. So we're not at the moment taking investment in Asia or South America, but other than that, we have no sector bias because our goal is to teach the investors what their investment thesis is. So what is it about what you think about the world that makes this company a better company than that company? And it turns out we don't all agree about that. And some people, want to make the environment better. Some people want to hunt unicorns. Some people want to make more women companies. Some people want to make jobs in my local community. All of those are valid investment theses. You have to do that. But if you're a unicorn hunter and you're investing alongside somebody who is a women-focused or an environmental-focused investor, you might find that you're not helping the company because you're pulling the company in different directions. And so mostly very early pre-seed companies need investors who are in alignment with their goals and who all help together to move the company forward. More than the money that they get, they want the help to go forward, introductions in the ecosystem, information about how to run a business well, a sounding board for decisions. All of those things are important components of angel investing. And if you have the wrong investor, you can kill your company. And so we're trying to create that alignment between the investors and the companies. And that alignment comes from spending time with each other so that you build a relationship so you understand each other. And so that's part of why it takes 3 months for us to go through the program, is to help build those relationships. Often, the company that does not win will get a relationship with an investor that helps them get invested later, or helps them decide on a pivot in their business that allows them to make progress. Yeah.
My question, I've been questioning myself many times in terms of when these companies, they go to accelerators, for example, let's say accelerators, and when they finish the program, what happened to them?
Really depends a lot on the relationships that the accelerator helps with, right? So if we look at Techstars Seattle, where I'm from Seattle, they have a very good program, and a significant number of the companies that go through their program get funded immediately, and even more get funded in a little bit. And they have made really significant progress over the last decade. So they've been running for 10 years. And those companies are getting big and going well, but they tend to be very tech focused. They tend to be software and software as a service. And so it's a narrow focus and going well, right? I know I've looked at accelerators that are impact accelerators in Vietnam, and there's no significant impact investor program in Vietnam. And so they go through, they have a company, there's no investment, maybe they get a business together and it's cash flowing, but it takes them a lot longer. And perhaps 10% get an investment from somewhere. And so an ecosystem needs to be balanced between the capital available and the companies. And if you expect that there are companies everywhere, then you need to have investors everywhere, essentially, right? So my program is a program to drive more local investors for the pre-seed so that they can get something out of an accelerator and get to the point where they're interesting to a broader range of investors, having demonstrated traction, having demonstrated growth.
I mean, you touch a very very close point to me, which is proximity. Do you think investors from Seattle can invest in Africa? Or you really, as you say...
Well, I know that they can because I have. The program called Pledge.co is a impact accelerator in Seattle, which has a particular African bias. And typically 6 out of the 8 companies in that accelerator are African companies, and they fly people over from Africa and they spend a lot of time. And in that time period, people build relationships. And we know that those relationships have turned into direct investment. The difficulty with investing in Africa is we're not clear what the path to exit is. And so we have to use different forms of investment to make the investment part work where we can get an exit. So I'm not going to list my African company that is a food, or there's a company that is a charcoal burning stove in Ethiopia, doing very well as a small business in Ethiopia, but it's not going to list on the New York Stock Exchange. So it can't have an exit through an IPO or a merger with a big tech company. So you have to do something else. And Looney Libs, who runs that program in Africa from Seattle, uses a mechanism called revenue redemption. And he wrote a book called Revenue-Based Finance. And so typically when we talk about venture investing, it's a very narrow group of companies that can succeed in the venture capital of the Bay Area kind of thing. It's less than 1/10% that actually get that kind of money. And so it turns out there are like at least a dozen different mechanisms for investment, which can be used to drive an investment in a company where an investor puts money in, and after some time, money comes back, right? That's our goal as investors is I take my money, I put it someplace, it grows, I get more money back. One of those pathways is a revenue loan. There's a company in Seattle called Lighter Capital. They do venture loans that are based on your revenue. So you don't have the trouble of having a term loan with a fixed cost when you're growing and have no revenue, which often banks will kill startups by doing that. So we can replicate that model as angel investors and do reasonably well. That's a different kind of business than what a unicorn business might be. So we have the choice of investing in growth, or we have the choice of investing in margin. And so if there's either one of these, we can then set deal terms that will allow us to have a reasonable investment. But at the very beginning of a company, the unknowns, the uncertainty of the market, the uncertainty of the company is enormous. And so the thing that binds all of this together is some level of trust. And so we have to build enough surface area between the investors and the company so that we have a level of trust and some level of expectation and some quality of communication that allows us to believe that an investment is possible in a reasonable way. Looney seems to do that reasonably well with this accelerator. He's gone on to produce a company called, a holding company called Africa Eats, because a large number of the companies in Africa are, at least impact companies, are oriented towards food and feeding people. And so he's building he is building an exit mechanism utilizing a holding company called Africa Eats. So given that you as an investor can see the method by which you get paid back, then that seems like a useful thing for you to look at those other alternative pathways besides just plain equity and then merger and acquisition.
But yeah, you need to find some way to secure in somehow the return.
Well, you have to have a path to a return.
Yeah.
I wouldn't use the word secure. I don't think
somehow, because it's
yes, but no, you say I'm going to secure my bank loan because I have my house as collateral. There's no collateral in angel investing, and when the company dies, and we're done, right?
Indeed.
And we know that, you know, in angel investing, 30% of the companies go to zero, and that typically happens like in the first 3 years, and then another 30% return some money, but not as much as you put in, and another 30% return a little bit more than you put in, but not a lot, and then only this, you know, 10% actually return. So the magic for angel investors is that they have to have a portfolio theory. And so if you have no investment thesis, it's very hard to construct a portfolio. And that's what we work on, is how do you build a portfolio theory that will get you into 20 to 40 deals that will produce a reasonable return and have the meaning that you want it to have in the world. So as an angel investor doing a good job at angel investing, I would expect to be in 20 to 40 deals. I'm currently more than 40 deals, where the outcome of that then gives me, you know, 3 to 4 times the money I put in.
What is the persona profile of your angels?
It's very different depending on which community I'm in. In Seattle, we have a significant number of tech workers. And so we have Microsoft employees, Amazon employees, this kind of thing predominantly. In Kelowna is full of entrepreneurs who have succeeded and decided to move to Kelowna because it's a nice place. And so they have a fundamentally different experience in our process because they ask a different set of questions, because their experience with running a business is different than what the experience of a Microsoft middle manager is. And so people learn different things and engage in different ways. In Alaska, it's a lot of small business owners who have succeeded in business on their own, probably didn't take outside money, or they're retired people who were one of the guys I remember specifically is a banker from New York who retired to go fishing in Alaska and invests on the side because it's fun. So really depends on the community. In our Transatlantic one, I think we skewed early, that the people are younger, more like 35 to 45 rather than 45 to 55. And they're typically tech oriented, where they have some success in their tech work. And now they're looking for what could I do? And they're sort of explorers. So the European people we had this last time, which we finished last week, are primarily explorers who are trying to decide, you know, what should I pay attention to next?
In terms of, you are now moving your concept to Europe, right? You start
Yes.
in America, you are from Seattle, they are moving to Europe. May I ask you, because I do still believe there are quite a few very strong differences between America, where venture capital was born decades ago. Europe, we are addressing this market right now. It's 10, 20 years, I would say 20 is very stretched a lot. So where do you see the main differences when you talk to startups, when you talk to angels between Europe and US?
I don't think there's a lot of difference in the startups. A lot of the same ideas, a lot of the same misunderstandings, a lot of the same kinds of things. I think one of the things that changes the landscape is that there tends to be early money that's easier from the government, where like in Seattle, there's no money from the government. If you're going to do something, you have to either do it yourself or you have to get somebody to support you. You're not going to get a government grant to do it. So I think on the startup side, there's not a lot of difference. Perhaps there's a willingness of the people. So I have been in communities where there's a lot of startups and they all got the 100,000 euros to do the thing that they were going to do. And they're all very happy working in their offices, taking a salary, and they're not moving as fast as they need to move for them to be successful, because that 100,000 is going to run out pretty quick. And so there's a certain slowness among some of them that have gotten funding, which I would not see so much in the United States because they wouldn't have gotten the funding. So they would be in a different mindset. But that's not very meaningful. On the investor side, I don't see the early young angels here so much. I see people who have been doing things with it for a while and that they're very wealthy. So in the United States, in order to be an angel investor, you have to have a net worth of over $1 million, not counting your house, or an income of $200,000 on a regular basis. That's not true in Europe. You can invest, you can make $60,000 a year in Spain and write a check to a startup if you wanted to. So the barriers to engage are different in Europe. However, nobody is doing it, right? The number of people, the percentage of people engaging in angel investing in Europe is much lower than in the United States.
That's my point. Do you think it's risk appetite?
I have a lot of people who think that it is risk appetite. There's people that think that, but I don't believe that it is a risk appetite question. I think it's an awareness question. They don't understand portfolio theory, and they don't actually understand what a business angel is. And part of that is because the people who are writing checks on a regular basis are what I would call ultra net worth people. So a startup typically wants a $25,000 to $50,000 check. And that's the sort of the minimum in general, because they're trying to manage their cap table.
Yeah.
And so if I'm a 5 millionaire person, my net worth is 5 million. And I am investing in 20 companies, and I'm going to invest 10% of my net worth in this crazy thing, angel investing. That means I can write 20 $25,000 checks. $5 million is my net worth, right? So now we're talking in the United States, we're talking something like 20% of all of the angel investors. So you've thrown away 80% of the angel investors because 80% are below 5 million in net worth. And so now we're like 0.02% of the population that can do that. And so what about the people that are just millionaires? Could they invest? Well, in Europe, there's no line, right? In the United States, at $1 million, I'm allowed to invest. But I should not be writing that check. So again, 10% of my $1 million, $100,000 divided by 20, 5,000. I should be writing $5,000 checks. That's why my program asks for a $5,000 check. We get $5,000 from 20 people. Now we're investing 100,000. That's a significant amount for the startup. Because we form an SPV around that, then the startup still only has one item on the cap table. And because we have 20 to 40 people in the group, the expertise in the group is significant, better than most individual $5 million millionaires, right? We have typically engineering minds. We typically have financial minds. We typically have marketing minds, all in that group. And so the company, if they're smart, engages with the whole of the investor pool and gains a lot of insight into what they're trying to do that they couldn't have done if they had one investor that was writing a single $100,000 check. And so I think, yes, there's a risk appetite question, but I think it's more about risk awareness. and understanding what and how this thing can work. I think the thing that is harder here than in the United States is that regional groups tend to be more closed here than in the United States. And so we have a much higher mobility. Europe is still trying to learn about mobility. But in the United States, I have many people from my college where I was in Illinois, which is in the middle of the country, which is like saying that they're in Poland and I'm sitting over on the other side of France, and they're all living near me, right? Hundreds of people from my university in Seattle. Well, why are they in Seattle? Why did that happen, right? Well, because professional mobility is high. And so I don't think that's true in Europe at the level of the United States. So when we look at that, if we take the United States and we pretend that each state is a country, like a country of Europe, and we look at Oregon, and Oregon is 3 million people, and we look at Washington and there's 7 million people. This is sort of like the Nordics, right? And in fact, we have a lot of Nordic cultural history in the West Coast in that space. So we have, like we have a statue to the King of Sweden in Seattle, right? Because there's this cultural relationship. We have the largest May 17th parade outside of Norway in Seattle. So compare Norway to Washington. All of the really smart people in Norway are still in Norway. All of the really smart people that were born in Washington, California, Chicago, New York, LA, there's a mixing force that moves people around, which is very, very different. And in fact, we have thousands and thousands of people from Chicago that live in Seattle, right? And so each generation, each year, we mix people. So the conversation about who should I work with is very broad. In Catalonia, there's a conversation about the people over in Aragon. They're different kinds of people. And so, that clustering is difficult in terms of getting people to engage, right? Because they're sort of checking with each other to see whether or not it's okay to do this strange thing. And then nobody's currently doing it, so we don't need to do that because we can do real estate and that works, right? We know that real estate works. It's very, very difficult to convert someone who believes firmly in a real estate play to think about a business angel play. They're like opposites of each other, right? But that's the point. Angel investing is uncorrelated with the real estate market. And so in order to be a good investor, you need to diversify your assets. And some of them should be in one kind of asset that is uncorrelated with this other kind of asset. So I put some in the stock market, I put some in real estate, and I put something that's uncorrelated with both of those.
Yes.
What could that be? Well, turns out startups take a long time to do what they're going to do. And when they do the thing, they're in a completely different ecosystem. The environment is different 10 years from now than it is now. And therefore, whatever they do is different than what I have now.
Absolutely. Can we close talking about your next program? The one is coming now.
Sure. We're going to run a Transatlantic Angel Conference. Starting, the workshops have already started, so people can engage in the workshops. There's a meetup group, meetup.com/startup investor accelerator. And the deadline to apply is the 7th of September. And our goal is to get 50 companies into that. And along the way, we're also going to have at least 25, and hopefully we figure out a way to change the SPV structure so that we can have 40, so that we can engage. And we'll start the next week evaluating the companies. And so if they go to the startup investoraccelerator.com website, they can get into the process of what we're doing. That program is designed as as a gateway process for us. And so we hope to train people as investors from all over Europe so that we can then go out to that specific locality and then grow a local one in person in that community. And so part of this program is a program to produce more in other places. So the person who is running the Transatlantic conference next apprenticed with the lead investor in the first one. So has seen how to set everything up and then is running it again. And we now have somebody in the south of Spain who is going to apprentice to be the lead for number 3. And so it looks like, we have a heartbeat where we'll be doing this 2 or 3 times a year. And then we'll do more as we find communities where we can get a critical mass of investors. So our goal is at least 20 people as investors in any particular community, and we can put together an investment thesis around that.
John, it's been a very great pleasure for me having you. I learned so much, and I'm sure startups, also investors, they will learn, angels, potential angels, they will learn a lot watching our video. Thank you very much. Thank you so much.
Thank you. That was great.
Thank you. My pleasure. Take care.